Hello students, in this video clip we'll practice how a bank operates, starting from taking deposits and lend some loans from the amount of the resources of the liability and equity. Okay, this is an example of entering a bank's balance sheet. To build the entering bank's balance sheet along with the transactions in the scenarios. Okay, first in the green section, Sirat deposits $1,000 to Anthony Bank. So we are creating Anthony Bank's balance sheet. If a client's deposit, that means that Anthony Banks has a liability with the name of account is deposit. So deposit, how much is that? $1,000. Now the total liability and equity by taking this deposit from Sirat client. So the cash is on the Anthony Bank's balance sheet. This $1,000 should be classified by the required reserve and excess reserve. As we discussed in class, the required reserve is required by the central bank to reserve a certain percentage of the current deposit. So it must be maintained for the last resort. And then excess reserve cash is not regulated, but it is extra buffer by the bank's judgment used for deposit withdrawal. So let's rewrite this, the Anthony Bank's balance sheet. Deposits $1,000, the same amount. Now this cash amount is reclassified by the two different types of cash. One is the required reserve. The other one is excess reserve. Required reserve required by the central bank to hold 8% of deposit for the last result. So 8% times 1,000. So the rest amount is automatically 1,000 minus 80, the required reserve. So 920 is excess reserve, with which this bank can decide to make a loan or some investment. Now number 3, Anthony Banks lends a loan out of this 920, 880, and the excess reserve now 4% by the management decision. Okay, now deposit, which is the same amount, $1,000. Out of this $1,000 required reserve is never changed regardless of how much amount the bank make a loans or excess reserve. So always the same percentage of deposit, 8% of deposit. If the central bank set the deposit percentage 8%, then excess reserve is 4%. There, 4% times 1,000. And then making loans is 880. So we have the $1,000 balanced out between asset and liability equity. Or you can just calculate by plugging in like this, the same result anyway. Okay, this 4% of the the excess reserve is determined by the management decision, management discretions. So you can increase or more excess reserve to prepare some a sudden the withdrawal from deposit, like 50 or 60, whatever. But by this amount, the bank should reduce the loan, right? If the bank decide to increase 900 loans, then this excess reserve should be 20, like this. Okay, but this 88% of deposit, which is required reserve required by the central bank, is never changed. to protect the customers, clients of the bank. Okay. So now we set up. Now we have two scenarios from the number 3 here. First scenario, the Anthony Bank being prosperous with deposit 10,000 and capital 900. Oh, the company increased the deposit. And capital, which is the equity, and then require the reserve still 8% of deposit by government. Excessive reserve 13% of deposit by management discretionary decision, making loans the rest amount of money, and securities investments like some other companies' stock or some the bond or some any kind of long-term investment. We say this is the securities investment for the rest of the total asset. So always starting from the liability, we have the deposit. Now deposit has been increased to $10,000, and then the capital, which is equity of the bank. The bank increased 900. There you go. So the total liability and equity is 10,900. That should be same as the total asset, 10,900 at the end of the day. Now the required reserves and excess reserves, and then loans, and the other one is the security investment. Required reserve, you remember 8% required by the government. So always the starting point 8%. So 8% times $10,000 deposit. So the required reserve now should be increased from 80 to 800 because the bank now got a more liability from the deposit, $10,000. So 800. And then excess reserve that management decided was 13%. Now the 13% times $10,000 deposit. So 1,300 is new excess reserve to prepare the withdrawal of the deposit, some deposit. Because $10,000 deposit is not going to be withdrawn at once, but some the big amount of a deposit can be the withdrawal. So 1,300 is the excess cash to respond to the deposit request, the withdrawal the request. The loan amount indicated 5,700. Then securities investment should be rest amount of money. How to get it? 10,000. Okay, 10,000 minus, we can just plug in 800 required reserve, the excess reserve, and loans. So we balanced out between total asset and liability. Security investment, 3,100. Okay, it is a subsequent event. Number 2, all of a sudden, CRED now decided to withdraw $1,000 from the Anthony Bank. The bank maintained the loans and securities. That means that the Anthony Bank responded this $1,000 withdrawal to from the excess reserve of 1,300. That is enough money. Okay, so let's start always from the liability. Deposit amount. Deposit now has been reduced from $10,000 to $9,000 because CRED withdraws, and the capital equity doesn't change. So 900. So the total liability and equity is now 9,900. That is going to be the same as the total asset amount. Okay, the required reserve, excess reserve. Okay, I'm gonna take the same name here. Then required reserve, now how much is required? 800? No, the deposit amount is now has been reduced to 9,000. So we have same percentage but different resource, the liability deposit. So 720 is new required reserve amount, not 800. You have to keep it in mind. And then excess reserve. How much is the excess reserve then? This excess reserve, how much is the excess reserve? Okay, how do we get it? Okay, now the loans and the securities investment has not been changing because excess reserve, we have enough excess reserve. So you have to remember the answer is not $1,300 minus $1,000, which is withdrawal. Oh, sorry. If we do like this, the total asset is not the same as total liability. Because by the amount of this deposit reduced, the required reserve $80,000 also reduced. So the excess reserve is not 300, okay? It is 380, okay? Or you can just plug in from 9,900 minus 720 new required reserve minus the loans they could maintain and security investment. So we got the excess reserve 380. Okay, again, you have to keep in mind that the required reserve has been reduced from 800 to 720 because the deposit, the resource amount is also reduced. So you cannot calculate $1,300 minus $1,000 simply because now we have a different required reserve. So the excess reserve calculated by this plugin. Okay, good. Now let's move on to the scenario B. On the scenario B, starting from this situation, the totally independent cases, Anthony Bank being prosperous with a deposit, capital 900, required reserve 8%, excess reserve 4% of the deposit by management discretionary decision. Making loan now 6,600, which is different amount, right? Why? Because the Anthony Bank decided to reduce excess reserve, not expecting that a lot of deposit, huge amount of deposit is not going to be withdrawn. So they decide to make more loan to make a profit. And the security investment is the rest amount of money. Okay, let's start it from there again. Now the deposit is now $10,000, which is the same as this case. And then capital equity also the same as this case, 900. So the total liability and equity is 10,900. Now required reserves, excess reserves. I would just want to take the same name of account. So the required reserve is same as this case, the scenario A. So 8%. So 8% times $10,000 deposit. And the excess reserve is 4%. The management team will make a decision, discretionary decision. They can increase or decrease depending on how much loan they want to make. So 4%, maybe as low as possible to increase their the uses of money. So 4% of $10,000 is 400, and then loan amount is 6,600, and then securities investment is just, we can plug in by subtracting all the assets from the total asset and liability equity. So 3,100, oh, this is the same amount of securities investment as a scenario in scenario A. Okay, let's develop the next subsequent event. Siret withdraws $1,000. Anthony lacks excess reserve. Why? The excess reserve is only 400. Only 400. But the whole sum of the amount of the withdrawal is $1,000, which is way higher than 400. So there will be kind of some trouble. So let's figure it out. How the Anthony Banks figure this out. So deposit amount 10,000 minus 1,000. So 9,000, and the capital doesn't change. Then required reserve. Okay, I just want to just copy and paste. Okay, the required reserve is now always a starting point because 8% is the required, never changed. So 720. How much is excess reserve? Excess reserve 400 is way lower than $1,000 withdrawal, the deposit withdrawal request. So it's definitely zero. So there's no excess, you don't have to calculate. And then the entering banks decide to reduce the securities investment. That means that they don't change this, touch this loans, right? Then security investment. How much should they sold today's how much they have to sell this security investment to make a cash to respond to this deposit. Okay, we can just plug in. So securities investment is 2,580. That is from 480 from the reduced amount of required reserve, and then rest amount from the securities investment. Okay. Okay, number 3, C-Red withdraws $1,000. Okay, Anthony lacks excess reserve and reduce loans. Okay, this is another option in the scenario B. Okay, okay, I want to just say this is not number 3 case. There's another case. Let's say there's another case. Number 2, that's 2. C-Red withdraws $1,000. I just want to copy and paste. Oh, just give me a second. What happened? Okay, let me just copy and paste this first. Or this. It's not working. Then the same loans and the securities and investment. I'm sorry, it is lagging sometimes. Then deposit and capital. I just want to just type down. Okay, this deposit, and then capital, equity. Okay, the same situation, 9,900. Then required reserve is 720. Then the excess reserve is 0 because 400 is very low. Okay, and then loans, because now the entity lacks excess reserve and reduce the loans. They decide to reduce the loan to pay out the deposit amount that was a shortage from this excess reserve. So loan is going to be calculated later. Then this 3,100 has not been changed. So we want to just plug in from this 720 minus 3,100. So now loan amount today the made that now is reduced 6,080. Okay. Now this case is C-Red withdraws $1,000. Anthony lacks excess reserve and increase borrowings from central bank. Okay, so required resolve, then excess reserve, loans and securities, investment. We have the same account, and then deposit and capital, equity, So the deposit amount is $9,000. Then capital is 900. But now this bank decided to borrow some borrowings from central banks. Now borrowings from central bank. Then how much do you have to put there? Okay, required reserve is 720 as we calculate 9,000 times 8%, and the excess reserve is 0. The company used up this, the bank used up this excess reserve for 400 because the total withdrawal is $1,000. And then they would not decrease this loan 660 or 6,600, and then securities. The bank wanted to maintain this amount. Then how much the bank should the borrow from the central bank? Now, okay, the difference between two, right? So it should be calculated like 10,420 minus 9,000 minus 900. So that we can balance out 10,420. So new borrowings from central bank is now 420. That amount, because of these borrowings, this CRED would take $1,000, and the entry bank would not reduce loans or security investment. Okay, this is all how we practice related to how the retail bank operate. It's very important exercise. Okay, see you guys in the next video clip. Bye bye.